that people need to be cautious and stay out of U.S. currencies. And again, I know that our clients are still down quite a bit on their long portfolios. Now, not nearly as much as we were. We've had pretty substantial rallies in the last week, but still, I understand that people are still down, but again, I still don't think it's going to matter, because when the dollar collapses, which I think will happen, I believe our portfolios will be worth many, many times what people originally invested, even for people who are down considerably right now during this, time when the dollar has strengthened. And something's going on with my computer here. So, and also I've noticed some things on the internet, some people when they try to point out that because the client, a lot of the Euro Pacific Capital clients are down, that somehow it invalidates my investment forecast. It doesn't. I mean, remember, I'm not managing these accounts. It's not managed money where I can, at a whim, buy and sell like people who manage funds. In fact, a lot of people somehow are confused who don't have accounts here, and they hear that my clients are down. They think that I'm managing money and I'm making bad decisions. We're not. The accounts that we have were set up to buy and hold. There was never an intention to try to time the market. It was always anticipated that we would ride out any short-term rallies in the dollar or declines in stocks. I did not believe that there would be this big a decline in our portfolios, because it was always my opinion that the dollar would be falling when global stocks started to decline. I obviously got that part wrong. I didn't forecast this short-term rise in the dollar that would present a better buying opportunity for foreign stocks and a better selling opportunity for dollars than what existed 6 months ago or a year ago. I mean, obviously, if I had a complete crystal ball, we could have waited and we could have, made all the investments right now. But since I didn't have that crystal ball, I had to act on the information I had. I thought it was prudent to play it safe and be out of the dollar. And I still think that ultimately, and a year from now or maybe less, people will realize that that was the right thing to do. That sure, people could have done better by waiting and buying now, but I think most people who waited will wait too long and end up doing nothing, and they'll be much, much worse off. I'm sure that my clients who have an account, and let's say a client is down 50% right now, I think that client is still better off, or will be better off, than the person who stayed in cash the whole time, because a year from now, that person who stayed in cash will still have his cash, but my client who is down 50% could be up 200% or 300%. Who knows? And ultimately, the person who stayed in cash could have absolutely nothing to show for it, because the cash can be worthless. But the stocks that we have, I think, will have real value. And remember that my clients at Euro Pacific Capital, in general, the brokerage accounts here do not include the investments that we made in gold to the Perth Mint. So if somebody's account is down 50% here, it doesn't mean that they're down 50% total, because they could still be up or down a little bit less, quite a bit less rather, maybe only down 10 or 15% on the gold portion of their portfolio. And of course, I also recommended that people keep some of their money in cash, waiting for buying opportunities like what we've had in the last few months. And obviously, most of my clients who followed that advice and who kept liquidity, kept cash for future buying opportunities, that cash is not a part of their account with me. That cash is held someplace else, and they only send me that cash when they want me to invest it. So when someone's account is down considerably, you have to remember that that is the equity portion of their account. That's the money that they wanted to commit to equities, and they sent it to me to buy those stocks. They didn't send it to me to manage. We're not managing the money. We are building portfolios of stocks that I believe to be relatively conservative, that pay high dividends, that are out of the dollar. And obviously, during a time period where the dollar strengthens and where stocks weaken, that account is going to go down in price or in market value. And we knew that going in. And my idea was not to manage that account. Also, I did advise many of my clients on the radio show and private conversations to invest on the short side of the market if they wanted to speculate, to short stocks. We didn't do that in a lot of the Euro Pacific accounts because I didn't think I could add that much value to a short sale, because anybody can short domestic stocks. I specifically said if you want to short stocks, short the financials, short the retailers, short the home builders. And many of my clients did that. A few of them did it through me, but most of them who did it through discount brokers. I mean, there was no reason to pay me a full service commission when they could just go and short stocks through their discount brokers. And so the people who did that obviously made money on their short investments. But from a more conservative standpoint, I didn't give that advice to a lot of people because I regarded shorting stocks inherently to be speculative, to be gambling. Now, it turned out that they were good bets because they paid off, but a lot of my clients were not suitable for shorting stocks. It seemed like that was more aggressive, even though in hindsight, obviously, shorting stocks worked. If we just went straight to massive inflation, shorting stocks could have been very, very disastrous. And of course, a lot of people don't necessarily have the temperament, or the resources to withstand, an unlimited increase in the price of a stock. Because obviously, when you're short a stock, there's no limit to how high the price can rise. I mean, if you're long a stock, there is a limit. It can go to zero. But if you short a stock at 10, if you're long a stock at 10 and it goes to zero, you lose $10. But if you short a stock at 10, what if it goes to 100? You've lost 10 times what the original price was. But so taken as a whole, I gave out a lot of very good investment advice, a lot of very good speculative advice. But obviously, for the people who've been buying foreign dividend-paying stocks, that portion, if you marked it to the market right now, obviously it's down, but I don't think it disqualifies the advice that I gave. Now, obviously you can look, too, at what's going on in the market. I mean, just take an example of gold stocks, because they've been very volatile. But the gold stock index, the gold stocks got clobbered in the last month, but now in the last 2 or 3 days, the Huey is up 60% in, I think, 2 or 3 trading days. Now, 60% is a huge move in just 2 or 3 days. Now, obviously, 2 or 3 days ago, somebody could have sold their stocks, obviously at the lows. Well, here we are 3 days later, they're 60% higher. Now, I don't know, maybe these stocks have finished falling. I mean, to me, if you look at the chart, I think there's a pretty good argument to be made that the lows are in. We'll have to see. But if the lows are in, when my gold stocks were 60% lower, were those losses real? I mean, does it really mean anything now after 3 days of a huge rally? And let's assume that gold stocks double in the next week. I don't know if they're going to do that or not, but let's assume that they do. Then this, almost the entire, 80% decline would be wiped out in a very short period of time. Did that mean that I had lost all of that money because for a while the paper value of my stocks was so low? Obviously not. Now, what it did mean is I lost the opportunity to have bought them cheaper, but how do I know if I even would? What if I didn't own gold stocks because they were falling, and I was watching them fall, and I was waiting for the bottom, and I didn't buy any a few days ago because I still thought they were going to fall, and I'm still sitting in cash, and now all of a sudden they're 60% higher. Will I be buying them now? Or would I be saying, well, they just jumped up 60%. Maybe I'll wait for a pullback. Who knows what I have done? Who knows if I would have availed myself of that opportunity? A lot of people try to point out that the whole idea that a paper loss, isn't a loss is all nonsense. But, sometimes it is nonsense. Now, when you buy a stock, that's all hype. Now, you buy some stock at 50 or 100 times earnings that doesn't pay a dividend. You buy some mania. And then the bubble bursts and the stock is way down, and you have a paper loss, and you want to pretend it's not a real loss by not selling it, then you are deluding yourself, in which case a paper loss is a real loss because you bought nothing. You bought hype, and the stock is still overvalued. And just not selling it, not realizing a loss doesn't mean anything. But if you buy a real company, and you buy it cheap, and you buy it, let's say, at 7 times earnings, and because of the circumstances of the market, because of certain liquidity events, that happen, all of a sudden that stock is selling at 3 times earnings. And now instead of paying a 7% yield, it's paying a 14% yield.